Testing 1 2 1 2 testing. Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from TikToker. Let's go right into the gold market here. Trading last at 1836.40, up about 270. For those people that are just joining me, first of all, welcome. I've been getting a lot of emails recently, and subscribers are interested in this, and I appreciate your interest. And for those that are coming in here pretty much recently, what I do here in the room, I trade primarily the gold, silver, the mini S&P, and GBTC in terms of the Bitcoin Grayscale Investment Trust. The focus that I have primarily is in the metals markets. It's in the gold market. And I use the variable change in price momentum indicator to identify day trading opportunities, as well as swing and position trading opportunities. So depending upon your profile, once you understand the logic of the algorithm, the artificial intelligence behind it, then you can use it to manage your portfolio. Now, when I say manage your portfolio, it doesn't tell you how to money manage your portfolio, but it does give you the direction prospectively in the market, and the artificial intelligence behind it pretty much tells you what to do. Now, one of the things that I find always is a challenge here for self-directed traders that are using this tool is the discipline, basically, of how to apply this intelligence correctly, in what market, in what instrument. And so the way that I look at how I apply this information, if I could go back here to just the beginning for the benefit of let's say, just regrouping the basics, you might say, of how to apply this information successfully. And once you understand how to drive the VCPMI, once you understand the different functions of the algorithm, such as what do these pivot points represent? What does the colors represent? Each of the functions here in color and each of these levels have a very specific artificial intelligence behind it. And that's pretty much what I'm sharing here for this 1 hour here. And for those that are interested in investigating further, you can reach out to TikToker here. We just published a book, Mean Reversion Trading. If you're interested in getting a copy of it, let us know. I'll be more than glad to share that information with you, which is really disclosing to you pretty much, in all reality, how I made $1 million last year using this. But in all fairness, the fact that I did that, it's irrelevant, it's done, it's in the past, and now we're looking at a new year. What are we going to do this year? And it's not as much as how great of a trader that I am and all the millions that I'm making. It's irrelevant to you. what I'm sharing here is the tool that I'm using to accomplish that. And everything being relative to your profile, your appetite for risk, and your skills for money management, you can make this work very successfully, particularly in this kind of environment where we have tremendous volatility coming into the market with the GameStops and the Reddits and all this new energy of traders that are coming in that provide simply the liquidity for the market to essentially implement this kind of volatility that we saw in the last couple of days with gold and silver. And as a trader, boy, that's like being a being a kid in the candy store in regards to volatility. Let me open up the chart here for a minute, and let's take a look at the daily chart. And what we see here basically is that the market on January the 6th, after making a high of 1962.50, activated a reversion or a reversal back to the mean. When this signal was activated, it activated the levels below, which is the mean and the levels below the mean. And so automatically it activates your targets, your levels, your targets that you want to use to lock in your profits if you are trading actively in the futures contract. You want to use these levels as your entry point. It identifies your target and your protective level. The target was completed. Market came down to the average price. And so now, in fact, it came down to the extreme below the average price, down to about 1,800 as of the 19th. From 1962.50 down to 1,800, that is $162 correction that the market took in 13 days. It's a significant increase in volatility. It came down right into the buy 1 and buy 2 weekly. The 1810 is the annual average for this year. And upon completion of this test, it reverted right back up to 1874. From 1810 back to 1874. So that's another, 50 or 60 bucks easily that we saw in fluctuation. And so again, I've been commenting here even prior to this Reddit energy that came into the market here recently, this highly speculative new energy that affected the market short term, but did not have any legs to sustain a rally to follow through. What we saw was the 1874. And on the 29th, we did penetrate that resistance level, which is the average of the month, which we've been looking at, and was not able to close above it, activating a bearish trend momentum that we are in right now, that basically the market is trying to resolve. So the price has come down to the average price of the annual, between the annual and the monthly average. So it's in a neutral to bullish kind of mix, bullish and bearish. Bullish annually, bearish monthly because it's trading below the average. Bullish annually because it's above the annual average. And we are, and that shows, in a consolidation phase. And so the artificial intelligence tells you that in the futures contract, pretty much you have a mixed bag of signals between the annual and the monthly, trading around the average price. What will happen here is that either the market will close below 1810 and activate a yearly and monthly trend momentum with a target of 1781. You see below the monthly buy one level. These are the targets that you want to use when you're trading in the futures markets, when you're following the artificial intelligence directing you to these pivot points. So as a futures trader, you want to lock in your profits as quickly as possible. When we take a look at the daily average now on the left that you see for today has been identified to be 1845. The buy one level is 1824. The market trading below the daily average price identifies the 1824 target. And we saw the market tried to come down here, came down to a low of 1830, could not find more supply to bring the price down, reverted right back up into the average daily of 1845. So if you carried a futures position overnight, and depending upon the number of contracts that you have, you want to use these targets to get out of your position, especially if you have one contract. If you have multiple contracts, you can use the levels above. 1860 is the sell one, and 1881 is the sell two level. So depending upon your profile, depending upon how many contracts you have, you can use these levels to get out of a multiple position, whether it be in the futures contract or in shares. Where we are right now on the daily is pretty much also bearish, neutral to bearish, because it's trading below the average price. And there is no day trading signals. There's nothing to do on the day trade. The market in general is fairly quiet. Derivatives are fairly quiet. And I'm looking at the board here. It seems that things have quieted down quite a bit after this panic buying that occurred this Reddit Wall Street Beats recommendation seems to have fizzled out. And if anybody bought into that, unfortunately, you're underwater, I believe. So that's the risk that you take when you follow the herd. And we have a saying in Wall Street, you know, if you follow the herd, herds get slaughtered. Pigs get slaughtered, hogs go to the market. These are just some of the things that come out of the reality, basically, of what happens when you're trading in these markets. That not only you have to measure the risk, the market, the instrument. And one thing that most people really don't talk about is how to manage your emotions during times like this, where you have the volatility just explode, and everybody in the social networks is talking about it. And in my experience, usually that is the time when you want to do the opposite. And if you take a look at what happened, to some of the stocks, they collapsed. And that's the chance you take if you want to trade that volatility. That is what I call speculation. What we're doing here is, first of all, we have identified a sector. As a trader, I have identified a sector that has the support of the fundamentals. And if you take a look at, where the fundamentals are right now, they have never been more bullish for precious metals than any other time in the history of these markets. We've never seen the debt at these levels here, which are astonishing levels, approaching $30 billion in debt, which is, I think the debt to equity ratio, we're looking at over 130% to GDP, which is a staggering amount, which pretty much, I think the markets are beginning to anticipate that this is going to be very, very negative for the US dollar, which is one of the reasons why everybody's flying into Bitcoin. People are beginning to sense that the dollar is at risk as they continue to print more and more and more money. And so I think our leaders are not concerned with the implications short term. And the danger that I think we have right now is that if they continue to erode the purchasing power of the U.S. world's reserve currency, it really puts at risk that the U.S. bonds can be downgraded. And as a consequence, interest rates will inevitably go up to cover for that risk. I think a lot of people are, in some way, have taken for granted the fact that, this is the U.S. It will never happen in the U.S. That kind of thing happens to third world countries. But unfortunately, if you take a look at what's happened here recently, it certainly feels like we're in a third world country. The lack of control over the pandemic, the way that they have managed the economic system due to the pandemic, they have broken the system as we knew it. People are unemployed by the millions. We're beginning to see shortages of food as we move into the summertime. So we seem to be going through a major transformation that not only is a crisis, but also an opportunity. And I think the Wall Street Beat guys read it, saw that opportunity. And the only difference is that technology simply leveled the playing field, in my opinion. You know, where you can get this kind of volatility into the market and change benchmarks or status quo, so to speak, that have been practiced for years on Wall Street, particularly with regards to short hedge funds, which is a major issue, really, that I think is not positive for the financial markets. You know, when you can have this kind of manipulation in the market, for example, the price of silver, the price of gold in relation to all these other instruments, even the intermarket relationships to the stock market, are completely out of whack. The stock market is in excess, exceeded 30,000, and we're at 1,800 in gold. We pretty much have only doubled where we were back in 1970 and 1981, when the Dow was at $1,000 and gold was at $1,000. We had a 1-to-1 spread relationship. The Dow, where is the Dow? In excess of 30,000, and gold is at 1,800. Slightly, you know, just double what it was. So when you really take a look at the monetary policies that took place, particularly after Nixon lifted the ban on the gold standard of the US dollar, we went into a debt economy. And that was really the purpose of lifting the gold standard, is to lift the ceiling and be able to borrow unlimited amounts of money, or create debt, or move into a debt economy, Keynesian economy, which is extremely inflationary. It's the idea that supply stimulus provided to the market can generate economic recovery. Unfortunately, I think if you look back at what's happened to the dollar since just 1971, it's lost about 98% of the purchasing power against the US dollar. Or the US dollar has lost 98% against gold. So you could see that the powers to be decided to control the price of gold and increase the debt economy, which made trillionaires at the present time. Billionaires were created. And we are at a point where this spread, has widened tremendously and has caused a tremendous wealth gap, particularly, in the stock market here, just going back to March of last year, when everybody just got killed in the stock market, what we have seen, and the stock market was down just like around 3,200 and change. And instead of collapsing, what you saw was the big money come into the market and buy these stocks They literally picked the blood off the streets, as they say, when they bought the stocks back in March. And we're trading now at what, 3,800, in that vicinity, making new highs. And if you go back and you take a look at basically what was the reason behind this reversal that we saw when the market came down to 2174, was the Feds coming in and confirming that they will print as much stimulus as necessary, no limits. And that just gave a put to the market, telling the investor, don't worry, the government is going to back us up. And the market just reverted from there to where we saw a high of 38.6225. It's almost 1,800 points since March of last year. So where are we going from here is the question. With regards to the stock market, I think, if you're not in it, you missed it. Unless we get some kind of a major correction in the market to allow you to buy some of this stuff relatively inexpensive or undervalued, but it's in no man's land, and it has separated itself from the reality of the economy. And I think because it continues to see that there is no other solution but for the Feds to continue to create money out of thin air, to continue to provide stimulus as much as necessary. And that's where we come to the present time right now, which is, what kind of stimulus is going to be provided to the market, what kind of support, what kind of a financial package is coming into the market. And I'm hearing rumors around $2 billion, $2 more billion of stimulus. But the longer that it takes for this money to come into the market, the deeper the damage in the economy is being done, the deeper the damage in small businesses that cannot sustain themselves, the deeper the damage just across the board from people that were counting on the stimulus to come out a lot sooner than the way they are handling the situation. So what does it mean? What does this whole thing mean to me as a trader, to you as a self-directed trader? When I take a look at the indicators, they're anticipating much higher prices in gold. The annual is looking at 2164. $21.64 to $22.42 as the targets. The 9-year cycle that we track as well is looking at 22.29 to 27.12 as targets. This is now for the next 9 years. During the next 9-year cycle, at any time, the cycle is looking for these prices to be completed. When we come in short term, we take a look at the yearly, and that is into that 2164 to 2442 level. I think we can clearly see that the market is tremendously supported, and the pattern is building to be an extremely bullish pattern. What we need is for the market to close above 1874. And I think once we close above 1874, we're going to accelerate into that 1942 2035. You can see the targets well above. So these are the targets that you want to use. Okay, now what is it going to get? What is it going to take for prices to get there, right? And I think what we just talked about, what I just mentioned with regards to the fundamentals, is the boiling pot underneath the base of the price right now in the 1800s. What I expect, and I continue to support this, and I share this information with my subscribers in my trading room, is that you want to buy into this correction and take advantage of this intelligently, using prudent money management, and in terms of your core position, you want to buy into this correction. As I feel the price of precious metals are like a pressure cooker. Not only fundamentally, but technically. When you compare, once again, the intermarket relationships to all these other assets that have exploded. Bitcoin, the stock market. So coming back to the gold market, I think it's just a question of time, and I'm comfortable with waiting patiently, because I think the surprises are going to be to the upside. And when this market begins to adjust, particularly silver, wow, $3 or $4 moves a day are going to be pretty much pretty common. So I know there's a lot of other activity going on, and as a trader, the GameStops, the AMCs and all that stuff, it's great. You can have fun with it. What I look for is a vehicle to make money, to supply the lifestyle that I have, to supply my family with the needs, with the things that I want to supply, to provide this information to my subscribers in my trading room, so that you can make a difference, so that you can change your life. These are conditions where these markets are offering the opportunity to do that. And, again, I'm sharing this completely transparently, this tool, which I've been using, and I've been around, for a little over 4 decades in this business. And the fact that I'm still around is something to really be thankful for, So it has allowed me to find longevity, to find stability, and to be able to manage the emotion factor, you might say, in this process of making money. That can be really, really a major deterrent in reaching your objectives. As I said, people don't talk about risk management, emotional risk management, and I think it's very important that you're aware of it, because again, one of the things that happens here is that this market tremendously makes you very emotional and greedy, you know. Um, and so manage that greed intelligently is exactly what I'm doing by using the VCPMI and having the discipline to stick to the program, so to speak, to stick to the AI instructions. So on a long-term basis, I think you're going to get rewarded very handsomely if you just be patient and you continue to build, continue to add to this markets here on any corrections. Let's take a look at some of the other markets here. The derivatives are a little bit of, as I said, a little quiet here this morning. Across the board, things have settled down from yesterday. Obviously, a lot of people are licking their wounds. And the markets are adjusting. So this is where you pretty much you want to come in once things stabilize. We can begin to re-enter. Our core position. The silver market is the one instrument that is the strongest out of the two. And the focus obviously is in the silver market for a good reason. It's the cheapest asset across the board. So it's got a lot of catching up to do to gold market. A little bit of sell-off here in the stocks, bringing it down to the average price of 38. Not quite getting up to that sell one level. So a little pressure here, profit taken on the mini. NASDAQ is trading below the average price, and it has activated a bearish trend momentum. So the pressure seems to be coming into the NASDAQ initially. The metals derivatives, double X, JNUG is slightly higher here. Nugget is a little bit lower. But trading below the average price, so it's neutral to bearish a little bit, and it's moving right into the buy level of 62.16. Dust, which is the bearish ETF that we use, is approaching 2072, slightly higher here, but right very close to that sell one level here. So what we want to see is pretty much how the gold market, reacts to these levels that we're looking at, and see how the derivatives follow, or who's following what, who's leading the move, so to speak. We're going to get a lot of volatility in the futures markets here, particularly due to the fact that they increased the margin requirements, I think, by 18% on Monday, which was another reason why there was this big sell-off in the stock market. It was liquidation due to the increase of margin calls. And this is how pretty much the regulators, the CFTC, control the price movement in the futures markets. The only difference is that they control, the upside, but they don't control the amount of supply that is being offered. In some cases, 10 to 1 more supply than what the market is producing annually. And that, to me, it just doesn't sound right, that they would allow this central bankers, to be short 10 to 1 futures contracts in silver when the production is not really that great. So how can you sell, production that doesn't exist? It's almost like what the short hedge funds are doing with GameStop, where they were short the stock 130%. How can you be short a stock more than the delta factor? More than 100%. But they allow it. They allow the central banks to do it. They allow the hedge funds to do it. And so there is a kind of a double standard in the way that, they handle this thing. But again, as a trader, the market provides the opportunity for you to be able to take these anomalies and profit from, without trying to change the system. And so that's what this VCPMI does for me. It takes away the chatter. I don't, I don't listen. I try not to listen to the chatter and let it affect me. But it gives you the ability to and the tool to gain the confidence to make your own decisions. How you manage that intelligence is a skill that you develop, but it's like learning to ride a bicycle, that once you learn to ride a bicycle, then it's a question of how you ride it and how fast you go, and, and so on and so forth. The core basis of the variable changing price momentum indicator is the reversion to the mean principle that identifies the extreme levels of the supply and demand of the market. It shows you when the price is undervalued, below the average, as it did here on November 30th, coming down to 1771. And on January the 6th at 1966.80, identifying that it was overpriced. So the function of the market, any market, is to find its equilibrium of the supply and demand. And that is why we use the average price, because the average price is able to identify for us exactly where that is in the markets that we're trading, currently, and look into the a monthly, the yearly, the weekly, the daily numbers and see how it relates to the market. And that's pretty much the map that I use. Unless we close, and we've been trying, here a couple of times uh, to get back above 1874. Seems 1842 seems to be the extreme, or the average price monthly, and the extreme below the mean is that 1781 level. So I think we've defined actually the market into a trading range that I think breaking out of either side is going to unfold the next directional move. Break above 1781 or a close below 1810 activates 1781 to 1713. Pretty clear. This is the monthly numbers that are going to be running for the rest of the month. A close above 1874 clearly is going to start the bullish trend momentum. In 1942 was the sell one target of the monthly resistance that also will become a challenge. So this algorithm has identified for us that the distribution area in gold is between 1942 and 2035. And this is the area where you want to manage your profits accordingly, depending upon your profile, depending upon your inventory. Pretty quiet day. Continue to just hold on to the position here. There's not really much that we can do. Everything seems to be pretty quiet. I think we found some support in the precious metals here from yesterday's sell-off. So what we want to see is more buyers to come in here, more volume on the upside. Once again, I do continue to support prices are going much higher in precious metals here. But you do want to be active in locking in profits. This is the important thing that I want to leave from this live streaming presentation is that if you're trading in the futures markets, you want to be more active in executing the pivot points. Upon entering a buy signal, you got your protective level is the level below. Your target automatically is the level above. And the rest is the market. The market will do whatever it's going to do. A little bit of sell-off coming into gold here. I'm not sure if the market is going to come down to 1824, which is the next buy one level here. So let's just keep an eye on this stuff. $18.30.10 so far is the low. The weekly signal is 18.29. Wow, that's pretty close. And now we're getting a reversal from there. Did the pattern complete it at 18.30? Let's just give it a few more minutes here. I am looking for reversions to occur from these levels. And at 8 o'clock, if the price does trade above the 1829, I think you can suffice to say that the pattern pretty much has met the completion. 1830, 1829, that's pretty close. So, but we got about 5 minutes before the signal is activated, and anything can happen in those 5 minutes. An aggressive trader coming down into this, given a 10% margin of error, probably would have executed this trade. And so, for aggressive traders, I would recommend buying at the market, for aggressive traders. If you want to follow the trade, it's an aggressive trade, but you can buy it at the market and use 1829 or 1830 as your stop. If you want to take the risk. Continue to hold your long positions here. If you enter into this trade, you can use the dollar stop, a maximum dollar stop of your choice, or you can use the close below 1830, which is the low, and automatically your target has been activated to be 1845. I hope that once again you are getting what you need by coming here, and every time that you do come, you become a better trader. Please take care of yourself. I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.